Hello people, this is Dr. Wang here recording. In this video, I'm going to cover Chapter 9, the cost of capital. And we just began our second half of the semester. The first half was mostly about investment in stocks and bonds and forming a portfolio, analyzing the risk and return. And in the second half of the semester, we are focusing on the corporate finance side of the course. And we start from the cost of capital, and then we move to capital budgeting and initial public offering. And here are the topics we are going to cover. And the most important part of this chapter is the weighted average cost of capital and also the factors that affect this formula of WACC. Well, what are the determinants of a stock's value or the firm value? Here, in the previous chapter 7, we learned about the free cash flow valuation model. And we have the firm value equals to the free cash flow generated by the firm from year 1 all the way to year infinity. And we are going to discount it by our weighted average cost of capital. This is our guide of the chapter. The free cash flow I have talked about a little bit in chapter 7. It is capital budgeting plus the operating profit plus the change in net working capital and so on. And it is the cash to spend by the managers and left to the shareholders. And right here, we are going to use the weighted average cost of capital to discount the free cash flows. So if you have a higher cost of capital, which is measured in percentage, then you would discount the same cash flows by more, and then the firm value would be less. And the cost of capital is made of a cost of debt and a cost of equity. And this is also determined by the firm's structure, the debt and equity mix, like what is the percentage of the assets is made of debt and what is the other percentages made of equity. And also for the cost of debt is mainly coming from the interest rate, and for cost of equity, it comes from the stock return and also the dividend yield. Of course, the risk would affect the cost of capital. If the firm has higher business risk, then the overall cost of capital would be higher. And likewise, if the stock market has a higher risk aversion, then people holding company stock would demand higher return to adjust for the risk. That would drive up the cost of capital. Let's say I'm running a restaurant business. I just opened up a Panda Express in the neighborhood, and I'm going to use a $200,000 capital. And you can think of capital as money, but you also need to understand after taking this course that a capital is the money will be converted to productivity and will generate return. So it's more like a financial sense and investment sense. If the $200,000 needed to start the business is purely from my own pocket, from me as the owner or the founder of the business, so it is called equity financing, and in particular, this is an internal equity. I don't have to share my profit to anybody or share the ownership to anybody, and this is the capital coming from internally from the shareholder. And there's no cost of capital. I don't need to pay anybody anything. And in the second scenario, I don't have a $200,000, but I can convince a bank to lend me $200,000, the $200,000 to start the business. And this time it is not internal financing anymore. It is external financing. It is from a bank loan. And if the bank charges me 8% interest each year, then my cost of capital for this business is 8%. And I'm going to use 8% as a discount rate for the cash flows generated from my Chinese restaurant business. And in another case, now I'm not going to borrow money. I abandon debt financing. Instead, I'm going to bring a partner. And I look around and I see Yao Ming. I say, Mr. Yao, would you like to invest some money in my business? And he said, okay, man, I give you $200,000. And we made some negotiation. He gave all the money needed for the business, and I will be the general manager of the business. And we made an agreement that the ownership will be split in half, 50-50. Although he inject all the capital needed, I spend zero money. Just because this is the structure, 50-50, then we will equally share the profit of the business. And for me, to attract Yao Ming's money, I need to give him some return, and that is the 50% of the business profit. Let's say if the profit for a year is $40,000, then for Yao Ming's investment, his cash flow will be half of the $40,000. So that is going to be $20,000 profit for Yao Ming, divided by his investment of $200,000. So that's a 10% return to Yao Ming as a partner or a shareholder of the business. And the 10% is, to me, is a cost of capital. I need to pay the investor, Yao Ming, 10% to attract his money. And for the companies, the capital structure could be decomposed into these components. We have debt financing. The firm can borrow money from a bank. They can also issue long-term bonds. We learned corporate bond in chapter 5. They can also issue short-term notes payable. So notes are for short-term, bonds are for long-term. And there's also preferred equity, common equity, and they both belong to the equity part of the capital. And we have learned about this in chapter 7. And in common equity, we can further break it down into common stock, the company's new shares sold to the investors, and also retained earnings. The retained earnings from chapter 3 is years and years of saving of a past profit minus dividend. And for the companies using long-term capital, they issue long-term debt, and some of them prefer short-term debt, and some have a temporary short-term debt for seasonal fluctuations in inventory. So if the company falls in short in the inventory or in cash, then they will need to borrow in a short run, and that could depending on the timing of the business. So if that is the case, then this kind of financing, short-term debt financing, usually is not part of the capital structure. And there's also tax effect. The interest payment to the debt holders are before tax. However, the dividends or other retained earnings payment to the stockholders are after tax. So we need to be clear about the difference. And when we're handling the cost of capital, we should know that cost of debt is before tax, and the cost of equity, which is measured in dividends, and also stock share prices, are after tax. The cost of debt could be reflected in the coupon paid to the corporate bond holders, and also the yield on the corporate bond issued by the firm. If you have not issued the bond yet, then you need to consider the other corporate bonds in the market that has a similar risk with your company. And here we have a new name for yield to maturity. While in chapter 5, we learned that yield to maturity could be many things. Yield to maturity is the annual return for the bond. It is the return required by investor to adjust the risk level of the bond and the company. It is also the discount rate for discounting the coupons and the face value, all these cash flows generated from the bond. And in this chapter, it is also cost of a debt for the bond issuer, which is a company. And if you can solve for this RD, the yield to maturity, then you have the cost of debt. So this is the cash flows generated from the bond. You have a 15-year, 12% semi-annual bond, and 12% is the coupon rate which you will use to generate the cash flows. It is a semi-annual, and that is a key important information. That means your coupon is delivered every 6 months, not every year. So you are going to convert 15 years to 30 semi-annual periods, and then divide the 12% annual coupon by 2 to get to the semi-annual coupon. So 12% times 1,000 divided by 2 will give you $60, and that is your cash flow in the first semi-annual period, second, third, until the 30th semi-annual periods. And then your final value, or the future value, is the face value of the bond, which is $1,000. And you plug in all the numbers and you solve for the yield to maturity, or the interest rate for this bond. And the interest rate I'm talking about here is the yield to maturity. It is not the coupon rate. The output will be 5%. The thing is, you should keep in mind that everything is on a semi-annual level. N stands for semi-annual periods, and the payment is made on a semi-annual basis. So the interest rate you solved will also be a semi-annual rate. So after everything is done, you get the 5%. You will still need to multiply it by 2 to get the annual rate. So 10% should be your final answer. And the last process is called annualization. Once we have the cost of debt, as I mentioned, this is a before tax, and everything needs to be on the after-tax level, because the cost of equity, which is the dividends, is after tax is paid. So we need to do some twist. We're gonna multiply the before tax cost by 1 minus the tax rate. If the tax rate is 40%, the after-tax part of the cost of debt, before tax cost of debt, is 10%, then the after-tax cost of debt is 6%. Right here, it mentions the flotation cost. Flotation cost is the commission fee charged by the investment banks for underwriting the firm security, and in this case, we're dealing with a corporate bond, so they are issuing bonds, and the investment banks will charge the commission fee. And the flotation cost is measured in percentage, and it is adjusted to the offering price. For example, if the bond is sold for $1,000 and the flotation fee is 5%, when they sell $1,000 worth of bond, they don't get the full price of it. Instead, they're only getting 95% of it, or 1 minus the flotation cost. So they are only getting $950. And where does the $50 go? The 5% flotation, it went to the pocket of the investment banks. So this is how the financial market goes. The financial intermediaries, like these banks, they provide services for offering the securities to the market. They help the firm to sell the securities, and in exchange, they will charge a flotation fee. So what do we need to do with the flotation cost in this chapter? All you need to remember is if a flotation cost ever appears in your questions, you just attach it to the current price of the security, no matter for stock or for preferred stock or for common stock or for corporate bond. Instead of getting the full market price, the firm is only getting the 1 minus flotation cost, the after flotation cost part of the price. All right, and here is one question about preferred stock. Well, preferred stock is pretty simple because the payments is fixed, as we learned in chapter 7. So right here we have a preferred stock. It has a current market price of $116.95, and the coupon payment is made on a quarterly basis. It's on a Q stands for quarterly, and the coupon payment is 10% of the par value, which is $100. The flotation cost is 5%. So in your calculation, you are going to solve for the cost of a preferred stock. Well, in this chapter, we need to adopt a mindset that the cost to the company, or the cost of a capital, is the return to investors. So the cost of preferred stock is the return to investors. For an investor, if that investor purchases the stock at this full price, and each year they are getting $10, and you are going to use these numbers to calculate their annual return. Well, the thing would get a little complicated once the flotation cost comes playing a role, because that will reduce the full price to the after flotation price. Since the flotation cost is 5%, then the firm, when they sell the preferred stock, they don't get the full price in their pocket. They're only getting 90% of that, with the 5% going to the investment bankers. In the previous chapter, we learned that the current price equals to the cash flow divided by the return, and this is called a constant growth model. And we just twist that formula a little bit, and we solve for the required return. So R equals to cash flow divided by price. So D is your cash flow divided by price. And once again, the price is after flotation price. And after you do the calculation, 9% will be your answer. And I hope you could spend 2 minutes or so to verify this number. When you do the exams, the formulas will be in the textbook, so I'm not quite worried about this. But you need to know that cost of preferred stock is the return for investing in preferred stock to the investors. And it comes from the cash flows generated each year divided by the price of the security. And for the firm, we need to consider the flotation cost, and we're going to attach the 1 minus flotation percentage to the current market price. If we lay out the cash flows generated by this security, this preferred stock, you can see that each quarter, well, this is a stock with a quarterly dividend payment. So each year they pay $10, then each quarter they pay $2.5. So that's a quarter one, quarter two, all the way to quarter infinity. Well, in the previous exercise, you see there's no place I actually incorporated the quarterly frequency. I don't divide 0.1 times 100 by 4. I don't divide the $10 by 4, because the frequency does not matter in this case. If you divide the annual payment, which is $10 by 4, to get a $2.5, which is your quarterly payment, 10 divided by 4 is 2.5, then you solve for the return divided by, which is the cash flow quarterly dividend, divided by the full price, the after flotation price. Then what you get here is a quarterly rate. And the cost of a preferred stock, cost of capital, is measured in an annual term. So once you get the quarterly rate, you need to annualize it. You need to multiply the quarterly rate by 4 to get the annual rate. So you divide 10 by 4 to get 2.5, and then you multiply the return by 4 to get the annual rate. So that dividing and multiplying would cancel each other. So essentially, you don't need to consider the frequency of the quarterly payment. All right. So for flotation cost, it is significant. That's why we are conducting it. Is a preferred stock more or less risky to investors than debt? The answer is more risky, because by the law of a corporation, the firm has to pay their debt holders first. To debt investors, their investment are more guaranteed. It's safer. However, the firms do not guarantee to pay dividends. Well, the preferred stockholders have a higher priority in terms of receiving dividends than common stockholders. Still, it is not fully guaranteed. Still, firms want to pay preferred dividend. If they don't pay dividend to preferred shareholders, then they can't pay dividend to common stock shareholders. The investors would lose faith in the company, and it will be difficult for them to get in more capital in the future. And if they don't pay preferred dividends, then there could be some covenant that the preferred stockholders may get control of the firm. In a normal situation, preferred shareholders or stockholders they don't have a voting rights. They just receive the dividends at a fixed amount. But if that dividend is not received, if firm is unable to deliver the money, then the preferred stockholders can exercise their right to vote and to get control of the firm, which means for preferred stocks, the dividends are more likely to be guaranteed than the dividends from common stocks. And then we talk about common stocks. So common stocks are available to the general public, just like you and me. And the firm issue the shares, of course, using the service of investment banks. That's actually only one way for raising common equity. You need to know that common stock is not exactly the same with the common equity, because common equity includes common stock. It also includes retained earnings. All right. So when the firm become public, they sell the shares. That's one deal, and that's just a number on the company's financial statements. And then the firm keeps making money, making the earnings year on year, on, and that part of the profit could be saved into the company's saving account, and that still belongs to the equity holders, common equity holders. So this is also part of the common equity. Once the return earnings accumulates, then the common stock price would increase. But if the firm pays dividends, then the stock would drop by the amount of a dividend. And this will be covered in chapter 14 later. Just for your knowledge, when the firm makes the earnings, they can either pay it out as dividend with a price drop, or they just keep the money, save it into the company saving account, and the stock price is still up. And once the stock price is higher, the investors can sell their shares and buy other securities and earn returns. Here are three ways to calculate the cost of equity. And the first way is a capital assets pricing model, as we covered in chapter 6. So we just solve for the return of the stocks. As I mentioned, in this chapter, we're going to treat the investment return as a cost of capital to the firm. So the return to the stock is the cost of equity for the corporation. And the second model is a discounted cash flow model. This comes from the formula in chapter 7 when we solve for the stock price today. So price 0 equals to dividend 1 divided by R minus G. And then we just twist that formula and put the R on one side of the equation and the rest on the other side of the equation. And once again, it is the required return of the stock. We just put it on one side of the equation, and that is the cost of capital. And the third way is more arbitrary and is also easiest if it's ever asked in your exam. It's called a own bond yield plus judgmental risk premium. So here is a premium. It's called a bond risk premium. It all comes to the idea that for the own company, for the same company, the stock is riskier than its bond. All right, as I mentioned earlier, bond payment is more guaranteed to the investors, but for common stocks holders, the payment is not that much guaranteed. And for stockholders, they need to be compensated. They demand extra compensation for that extra amount of risk for the stock, and that a premium will be added to the return of the company's bond. So you just use the before tax cost of debt plus a given number to get the cost of equity or return of a stock. All right. And we have done several exercises in chapter 6 for CAPM, and I'm not going to spend too much time on it. And right here, I just want to mention the RPM is risk premium for the market, okay? And that equals to the market return minus the risk-free return. And right here, we have a dividend growth model. So you solve for R and it's a D1 over P0 plus G. And if D0 is given, you have to pay attention to this one. Sometimes I say the firm is going to pay a dividend at XYZ dollars in the next year, and then you should realize this is a dividend 1. And sometimes I say the stock just paid a dividend today at XYZ dollars, then you should know that this is dividend 0. So it's really about the timing of the dividend is paid. So if it's dividend 0, then you have to calculate dividend 1 by multiplying dividend 0 times 1 plus G. All right. So with these numbers are given, you should have no problems getting the final result. So just spend 2 minutes or so to verify this answer. All right. And the next one is the bond risk premium method. So we have already solved for the cost of debt or the return to the bond, same thing. And we just add an arbitrary number, which is called a judgmental risk premium, because the stock is riskier than the bond for the same company, so the return has to be higher. And you should know that this judgmental risk premium does not equal to the equity risk premium or the market risk premium times beta. So it's just an estimate, and for you, it's pretty easy to calculate because that number should always be given. All right, so there are 3 methods for a firm to calculate the cost of equity, and you can just take the average of all the 3 estimates to get the overall cost of equity. I have talked about cost of debt, cost of preferred stock, and a cost of common stock. Then the next thing you're going to do is to get the weights of each of the component capital in the overall capital structure. Here is one example. Suppose the stock price is $50. There are 3 million shares of stock outstanding. The firm has 25 million of preferred stock and 75 million of debt. The weight here should be in percentage. So you are going to get the total amount of capital and then get the proportion of each component, common stock, preferred stock, and debt, as a part of the total capital. So the first thing you need to do is to get the capitalization for the stock or the common equity, which is the stock price times the number of shares. And then you have the preferred stock and the debt given to you at the market value. You just simply add them up. So your total is 250 million. And then you need to solve for the percentage. Each of the individual capital divided by the total to get a percentage. And then the last step here is to use this WACC formula. Actually, your entire chapter is built on this formula. I have addressed cost of a debt, cost of a preferred stock, and a cost of a common stock. And then we solved for the weights of each of the component capital. We plugged in the numbers. And of course, for cost of debt, we're going to use the after-tax part of it by multiplying 1 minus the tax rate. And then we solve for the WACC. And trust me, this will be tested in your final exam. And what will be the factors that affect the firm's cost of capital, affect the WACC? There are some uncontrollable factors to be affected by macroeconomics conditions. For example, the interest rate. Well, in Chapter 5, we learned that for the bond yield, or the return to the bond, or the cost of debt in this chapter is built on the basic interest rate. So if the interest rate goes up, the risk-free rate would go up. So the bond yield should go up accordingly, and vice versa. And also the market risk premium could fluctuate depending on the overall stock market's performance. And that could affect the individual risk premium, which is for the company, and that could affect the stock return for the company and then the cost of capital for the company. And also tax rate would play a role for the cost of debt. And some of the factors could be controlled by the firm. They can adjust the capital structure. So instead of putting 60% of capital in common equity, they could put a 70% or 40%. It's their choice. They could also decide to pay dividends at a higher level or at a lower level. And the dividend payment is attached to the cost of equity when you solve for the return of stocks. And the firm can also decide their investment policy. They could be conservative or they could be aggressive in taking risky projects. So if the firm are full of risky projects, like opening an oil drill platform in Venezuela, which is deemed to be nationalization of local government, that's called a risky project. If that happens, then the investors would see this company as a risky company, then the firm would have a hard time to raise money, so the cost of capital for them would be high. I just want to mention flotation cost again for new common stock, the cost of this capital. So as I said, if flotation cost ever appears, you should attach it to the price. So right here, we have a stock sold at $50 and a dividend zero is a 3.12, growth rate is 5.8%, flotation is 15%. So we use the formula, the required return equals to dividend 1 divided by price plus G. But for dividend 1, it's not directly given. You need to solve for that by using dividend 0 times 1 plus G. And for the price, instead of using the full price, we're going to use the after flotation part of the price, or 1 minus 15% of the $50. The 15% of the $50 would go to the investment banks, so the firm is only getting 85% of the full price. And then we do the calculation.